Welcome back. We will be looking at the first ratio or the financial measurement metric that is relevant in your syllabus when you're looking at an investment center manager or manager's performance, ROI, return on investment. Now, it's a fairly straightforward ratio. I understand that you already know this, and we are only doing sort of a recap just because we want to understand it from an APM perspective. ROI is the divisional equivalent of ROCE. So we looked at ROCE in chapter 8. We learned that ROCE is a ratio that is a blanket ratio. You can apply to the whole company. So you take that and develop a investment specific version of ROCE. You call it ROI. And you use that on the division. So divisional operating profit divided by the division's capital employed into 100 is what you get as ROI. The decision rule is simple. For the division, what you do is you look at your cost of capital. Could be debt, cost of debt alone, maybe interest rate, or it could be cost of equity, or it could be both, depending on how your division is made up of. So you get the cost of capital, that is your expenses, right? That is your cost of capital. On capital, how much you have to, what is the amount you have to incur to keep servicing that capital. So if your return ROI is better than that, obviously it's a good situation. It means that your division is making excess than the servicing cost of that capital that the division is made up of. So that's how you use. Now, what exactly happens with the issue, or what exactly happens with the ratio, is that because of the nature of the values that I used, there are some advantages and disadvantages. Advantages, it's very widely used, it's very common even nowadays. Whenever you go somewhere and you pitch to an investor, one of the first questions is what is the ROI. That's so common. As a relative measure, it enables comparisons because it's a percentage, and it can be broken down into secondary ratios. I'll show you how. Um, the two separate ratios that you can break ROCE or ROI is the profit margin of the division and the asset turnover of the division. So when you take the profit margin and the asset turnover and you multiply them, you get your ROCE or ROI for the division. So necessarily, if you want, you can break down your ROI into profit margin and look at profitability, and you can break it down into asset turnover and look at a mix of profitability, semi-profitable understanding, and a semi-liquidity understanding. Your asset base, right? How much are you generating for your assets in terms of revenue? So that opportunity is there, which is also quite common, and a breakdown that is generally looked at. Um, However, there are certain disadvantages with ROI. Dysfunctional decision making can be promoted because ROI is something that can drive people to decide what's best for them at the expense of what is best for the company. ROI can increase with the age of assets if net book values are used for your capital employed figure, especially with non current assets, because your net book value is going to go down as time passes by. So, if you're not really using the market value or something like that, then what will happen is your ROI will keep on increasing, and that may look good on paper on the book, but that might not actually work well for the company. It is not aligned to the corporate objective of maximizing total shareholders' wealth because this is purely a profit and a financial numbers game. We will see how so this is also part of leading a divisional manager to make suboptimal decisions, and differences between the internal divisions being compared, or between the division and the external company it is being compared to, may make comparisons less meaningful because there is no common base, even though it is a percentage based ratio which allows you to um, calculate, or which allows you to compare in terms of numerical terms. But depending on the nature of the business, the times of the business, the life cycle of the products, there are so many other factors, non-financial especially, that can affect this ratio in a way that makes the comparison in nature in irrelevant. So, furthermore, you have exclusion from capital employed of intangible assets such as brands and reputation, because capital employed, most of the time you tend to use the non-current asset or physical asset values. So, what if you're a business that is made up heavily of intangible assets, like a network structured business, like an online retail business, like what I am doing, like a teaching sort of business? And it may encourage the manipulation of profit because you're using statement of income statement and capital or balance sheet figures, and those numbers are coming from mostly coming from international accounting standards or IFRSs. And you know very well, if you've done SBR, you know very well how many IFRSs are regularly changed, and how many IFRSs are completely unreliable. On that note, okay, so this is the thing. There are a few examples in your book for you to try with the answers that prove some of these issues. For example, in this question, test your understanding one, what happens is you will John invest in the new equipment? Is this the correct decision for the company? That's the question. So when you do the calculation itself, you realize that if ROI is used, then John is actually making a decision that is not good for the company, but good for him, right? So this is dysfunctional decision. So John will actually, I think, disapprove the investment decision, while it would have been the right thing to do to invest and purchase the asset. But if John does that, John's ROI will go down, and therefore John's reward, bonuses or whatever, salary increments, promotions, whatever can get affected. So what did John do, or what will John do? Reject the investment, which is not good for the company. Dysfunctional behavior. So you can try it out. Now, what I want to say is you can refer, in addition to this, I'm doing a separate video, which I'm providing you with, which has the calculation versions of this entire chapter, all of the, calculation related discussions. So I want to focus these segments on the APM related, the technical understanding and how it works and what is related to us, because calculations are not tested in the APM exam. The other example you have is at about the age of assets. It proves that with book value, while you're using a net book value approach, the as an asset, or as your asset base ages, your ROI keeps improving, obviously, because your denominator keeps falling. And is that a good thing? Does that mean that the division is doing well because you're with your age of assets? And what it can do is that a manager, maybe he needs, it's been 10 years since that the asset is being used. Maybe it's a factory machine or something, CNC machine, let's say. So 10 years now, and the book value is being used. So every year the machines, utility machines, servicing that and this, the machine keeps on aging, but ROI keeps on going up because the denominator keeps falling, right? The value of the asset. Now by the 10th year, it's time to replace this. Now it has come to its peak, right? It cannot do much more. If you keep using more, it's actually inefficient for the company. But what will the manager do? The manager will try to hold on to it as long as possible, because the net book value is being used, and therefore the denominator will keep on falling. And for the 11th year, if the manager uses the asset, then the net book value will go further, denominator will go further, manager's ROI will look better. And that may mean that manager is getting rewarded more. But is that true? Is that correct? Absolutely not. What happens is that so this leads to suboptimal decisions and dysfunctional decision making. That's the proof there, which you can try and which you can test in your yes, which you can test in your by yourself with your time. And you can review the video where I'm discussing the calculation perspective as well. So that link and on top of it, if you have any further challenges, we will be looking at it in the live one-to-one. Thank you, and good luck.